The housing market in 2025 is serving up opportunities that most people are completely missing. While everyone's waiting for the perfect moment to buy or sell, smart investors are quietly making fortunes by understanding 5 critical trends that are reshaping real estate right now. What I'm about to reveal could be the difference between watching from the sidelines and building serious wealth this year. I've been analyzing market data from across the country, and what I've discovered will shock you. We're not in a normal market cycle. We're in a period of massive disruption where traditional rules don't apply, and the investors who understand these new dynamics are positioning themselves to make incredible returns. Today, I'm going to break down 5 housing market trends that could make you rich in 2025. These aren't theoretical concepts or wishful thinking. These are real market forces, creating real opportunities for people who know how to spot them and act on them. By the end of this video, you'll understand exactly where the smart money is moving, which markets are primed for explosive growth, and how you can position yourself to profit from the chaos that's confusing everyone else. But here's the warning. These opportunities won't last forever. The investors who move first will capture the biggest gains, and the ones who wait will be left wondering what happened. Let's start with the trend that's creating the biggest opportunities for cash buyers and creative investors right now. Trend number 1. Mortgage rates are dropping, but not fast enough. This is creating a massive opportunity gap that smart investors are exploiting, while everyone else sits on the sidelines waiting for rates to fall further. Here's what's happening. After peaking in 2024, mortgage rates began easing in 2025 when the Fed started cutting rates in September. But here's the problem. Rates are still hovering around 6.45%, which keeps monthly payments painfully high and buyers cautious. Let me put this in perspective. A $400,000 home with a 6.45% mortgage costs about $2,600 per month in principal and interest alone. Add taxes and insurance, and you're looking at over $3,000 monthly. For most buyers, that's simply unaffordable. But here's where the opportunity lies. While traditional buyers are paralyzed by high rates, cash buyers and investors using creative financing are dominating deals. They're getting properties at discounts because there's less competition, and they're not dependent on traditional financing. I know investors who are using private money at 8 to 10% interest rates and still making incredible returns because they're buying properties at such steep discounts. When you can buy a property for 20% below market value, paying a higher interest rate becomes irrelevant. The creative financing strategies are where the real money is being made. Seller financing deals where the property owner acts as the bank, subject to transactions where investors take over existing low-rate mortgages, lease options that allow control without immediate purchase. Here's a real example. An investor in Phoenix found a seller who needed to move quickly for a job relocation. The house was worth $400,000, but the seller had a 3% mortgage from 2021 with a balance of $300,000. Instead of forcing the seller to pay off the mortgage and lose money, the investor took over the payments subject to the existing loan. The investor got a $400,000 house with a 3% mortgage, and the seller got out from under a property they couldn't afford to keep. Everyone won, except the traditional buyers who were waiting for rates to drop. But the rate environment is creating opportunities beyond just creative financing. It's also creating a massive inventory problem that leads us to trend number 2. Baby boomers are sitting on inventory, and this is creating one of the biggest opportunities in real estate right now. Here's the situation. Boomers own twice as many 3+ bedroom homes as millennials with kids. Think about that for a second. The generation that needs space for growing families can't access it because the generation that no longer needs that space won't give it up. Many boomers want to downsize, but they can't find affordable alternatives, so they're staying put in homes that are too big for their current needs. This is creating artificial scarcity in the family home market, while creating opportunities for investors who understand the dynamics. The boomers aren't staying in these large homes because they love maintaining them. They're staying because The math doesn't work for downsizing. A boomer who owns a 4-bedroom house worth $600,000 might want to move to a 2-bedroom condo, but those condos are selling for $500,000. After transaction costs, they'd barely break even, and they'd lose the space and privacy they're accustomed to. This creates multiple opportunities for savvy investors. First, you can target aging homeowners with downsizing solutions. Partner with them to buy their large homes while helping them find suitable alternatives. Sometimes this means buying their home and renting them a smaller unit on the same property. Second, ADU conversions are becoming incredibly profitable. Accessory dwelling units allow boomers to stay in their neighborhoods while generating rental income and reducing their housing costs. An investor can buy a large property, add an ADU, and create multiple income streams while helping solve the downsizing problem. I know an investor in California who specializes in this exact strategy. She finds boomers with large properties who want to age in place but need additional income. She buys the property, builds a beautiful ADU, and rents the main house to families while the original owners live in the ADU. Everyone gets what they want. The boomers get to stay in their neighborhood with reduced expenses, families get access to larger homes, and the investor gets cash flow from both units. The key insight is that this isn't just a temporary trend. The boomer generation is massive, and they're all facing the same downsizing challenges simultaneously. Investors who position themselves as solution providers will profit for years to come. But while some markets are constrained by inventory, others are experiencing dramatic shifts that are creating opportunities for investors who know where to win. Look, trend number 3. Regional shakeups are creating massive opportunities for investors who can follow the money. We're seeing markets that were red hot just 2 years ago cooling dramatically, while other markets that were written off are suddenly booming. Let's start with Denver, which is experiencing one of the most dramatic market corrections in the country. Home values dropped 4.6%, listings surged 32%, and bidding wars have completely vanished. For buyers, this is great news. For investors, this is an incredible opportunity. Denver's correction isn't happening because the city is dying. It's happening because prices got so far ahead of fundamentals that a correction was inevitable. The city still has a strong economy, growing population, and limited developable land. What it doesn't have anymore is the speculative frenzy that drove prices to unsustainable levels. Smart investors are moving into Denver now, while everyone else is scared. They're buying properties at 20 to 30% discounts from peak prices, knowing that Denver's long-term fundamentals remain strong. When the market stabilizes and rates eventually come down, these investors will be sitting on massive equity gains. But here's what's really interesting. While Denver is cooling, Manhattan's luxury market is absolutely booming. Sales are up 13.6%, and 90% of deals are closing in cash. This tells us something crucial about the current market dynamics. High-end buyers are insulated from rate hikes because they're not dependent on financing. They're buying with cash, and they're driving luxury markets to new heights while middle-market buyers are priced out. This creates opportunities for investors who understand how to follow the cash. In Manhattan, investors are buying luxury properties, knowing that wealthy buyers will continue purchasing regardless of interest rates. But they're also buying in markets like Denver, where high-end buyers are getting incredible value compared to coastal markets. The key insight is that money is flowing to extremes. Ultra-luxury markets with cash buyers are thriving. Ultra-affordable markets where investors can buy with cash are thriving. It's the middle markets dependent on traditional financing that are struggling. This leads us to trend number 4, which is creating opportunities in the new construction space that most people are completely missing. New builds are facing competition like never before, and this is creating opportunities for investors who understand supply and demand dynamics. Builders are ramping up supply after years of underbuilding, but resale listings are rising too, creating pricing pressure that smart investors can exploit. Here's what's happening. Builders who couldn't keep up with demand during the pandemic, boom, are now completing projects just as demand is cooling. Meanwhile, Existing homeowners who couldn't sell during the inventory shortage are now listing their properties. The result is more supply hitting the market just as buyer demand is weakening. In markets with surplus inventory, buyers are negotiating harder and demanding modern amenities. This is forcing builders to offer incentives and concessions that create opportunities for investors who know how to negotiate. I know investors who are getting brand new homes with builder incentives that effectively reduce the purchase price by $50,000 to $75,000. Free upgrades, closing cost assistance, rate buydowns, and even cashback at closing. These incentives aren't being advertised widely because builders don't want to damage their brand, but they're available for investors who know how to ask. The flip side of this trend is that existing homes without modern amenities are struggling to compete with new construction. This creates opportunities for investors who can buy older properties at discounts and update them with the features that buyers want. The key is understanding which markets have balanced supply-demand dynamics versus which markets are oversupplied. In balanced markets, both new and existing homes can succeed. In oversupplied markets, only the best properties at the best prices will sell. Smart investors are targeting markets where they can either get incredible deals on new construction or buy existing properties that they can improve to compete with new builds. The middle ground of average properties at average prices is where investors get stuck. But the biggest opportunity of all comes from understanding that the affordability crisis isn't a problem to solve. It's an opportunity to exploit. Trend number 5. Affordability is still broken, but that's creating massive opportunities for investors who understand how to profit from market dysfunction. Despite more listings and slower price growth, many buyers remain priced out, and this is creating opportunities in mid-tier markets that most investors are ignoring. Here's the reality. The median American household cannot afford the median American home in most markets. This isn't a temporary problem that will be solved by slightly lower interest rates. This is a structural issue that will persist for years, and smart investors are positioning themselves to profit from it. Take Clarksville, Tennessee, for example. Homes sell in about 69 days with modest competition. This isn't a hot market that's going to make you rich overnight, but it's a stable market with consistent demand and room for appreciation. These are the markets where patient investors build wealth. The key insight is that affordability problems create rental demand. People who can't buy homes still need places to live, and they're willing to pay premium rents for quality housing. This creates opportunities for investors who can provide rental housing in markets where home ownership is out of reach for most residents. But it's not just about rental properties. The affordability crisis is also creating opportunities in markets that are still accessible to middle-class buyers. These markets might not have the explosive growth of hot coastal cities, but they offer steady appreciation and strong cash flow potential. I know investors who are building portfolios in markets like Clarksville, Huntsville, Alabama, and Boise, Idaho. These aren't glamorous markets, but they're markets where working families can still afford to buy homes, where rental demand is strong, and where property values appreciate steadily over time. The strategy is to target markets with strong employment, growing populations, and home prices that are still reasonable relative to local incomes. These markets might not double in value overnight, but they provide the steady returns that build long-term wealth. Another opportunity within the affordability crisis is the build-to-rent market. Investors are building single-family homes specifically for rental, targeting families who want the suburban lifestyle but can't afford to buy. These properties command premium rents and attract long-term tenants who treat the properties like their own homes. The build-to-rent strategy works particularly well in markets with strong job growth but limited housing supply. Families moving to these areas for employment need housing immediately, and they're willing to pay for quality rental properties while they save for eventual home ownership. So how do you profit from these 5 trends? First, you need to understand that this isn't a normal market, and normal strategies won't work. You need to be more creative, more flexible, and more willing to take calculated risks than the average investor. For the mortgage rate trend, focus on cash purchases and creative financing. Build relationships with private lenders, learn about seller financing, and understand how to structure deals that don't depend on traditional mortgages. For the boomer inventory trend, position yourself as a solution provider. Learn about ADU, construction, understand downsizing challenges, and create win-win scenarios that help boomers while generating profits for yourself. For regional shakeups, follow the money and the data, not the headlines. Markets that are cooling might offer the best opportunities, while markets that are hot might be overpriced. Do your own analysis and trust the numbers over the emotions. For new construction competition, learn to negotiate with builders and understand how to add value to existing properties. The key is positioning yourself where you can either get incredible deals or create incredible value. For the affordability crisis, focus on markets and strategies that serve the needs of people who are priced out of home ownership. Rental properties, build-to-rent, and affordable markets all offer opportunities for investors who understand the dynamics. The bottom line is this: 2025 is not a year to sit on the sidelines waiting for perfect conditions. Perfect. Conditions don't exist in real estate. What exists are opportunities for investors who understand market dynamics and are willing to act on them. These 5 trends are creating wealth-building opportunities that won't last forever. The investors who understand them and act on them now will be the ones building serious wealth, while everyone else is still trying to figure out what's happening. The housing market is broken in many ways, but broken markets create the biggest opportunities for investors who know how to navigate them. The question isn't whether you can make money in this market. The question is whether you're willing to do what it takes to capture the opportunities that are right in front of you. Which of these trends resonates most with your investment strategy? Are you seeing these dynamics in your local market? Drop a comment and let me know which opportunities you're planning to pursue. And if this analysis helped you understand the current market better, hit that like button and subscribe for more real estate content that cuts through the noise and focuses on what actually matters for building wealth. Remember, the best time to invest is when others are confused and scared. Right now, most people don't understand what's happening in the housing market, but you do. The question is, what are you going to do with that knowledge?